Tensions keep rising between China and the US, the world's two largest economies and effectively its only economic superpowers. But within an increasingly fractured Sino-American relationship, the two sides have engaged in something of enthusiastic, you could even say passionate embrace: finance. One of the most evident signs of this has been the large and growing value of Chinese company shares listed on American stock markets. A robust China to Wall Street IPO pipeline connecting Chinese companies to the New York Stock Exchange, NASDAQ, and over-the-counter stock markets in America has been going strong for almost a quarter of a century. It's a bilateral trading relationship that predates China's entry to the WTO and has exchanged trillions of dollars in value between China, the US, and other economies connected to America's massive financial system.
Hi, I'm Rob Kep, looking to fit together another piece of the geoeconomics puzzle. Here we'll consider the position of Chinese stocks in American stock markets through the lens of the high-profile IPO and market crash of Didi, China's largest ride-hailing app. Although covering the specifics about what's happened with a single Chinese stock, we'll see how hundreds of Chinese shares listed in America are facing a mass financial exodus from Wall Street. And while discussing international stocks and investment, more fundamentally, we'll be examining US-China economic relations and the future trajectory of China's economy.
By the middle of 2021, 248 Chinese companies were listed on major U.S. exchanges, reaping a total market capitalization of $2.1 trillion. That level of capitalization is larger than the GDPs of Italy, Canada, or South Korea. Basically, any national economy outside the world's top 7. Needless to say, China's IPO pipeline into Wall Street has been exceptionally valuable for both sides. The latest, and now it's looking like the last, standout example of this high-performing global financial relationship in action was the hotly anticipated initial public offering of shares in Didi, China's, and by some measures the world's, largest ride-hailing app. Didi is the equivalent of a Chinese Uber, and then some. Like many Chinese companies before it, Didi had decided to list in the United States instead of the closed capital mainland Chinese stock markets of Shanghai or Shenzhen, or even the globally integrated bourse of Hong Kong. There are many reasons for this, but the most basic level concern the sheer size and liquidity of the NYSE and NASDAQ, which offer the largest pools of public equity capital on the planet by a very wide margin. U.S. markets also offer less stringent listing requirements, a feature attractive to a share-issuing company's management and its backers, plus require high degrees of transparency and corporate governance, features favored by stock market investors. On top of this, American stock market regulators are part of a politically independent government bureaucracy. An added bonus, shares in America are denominated in the US dollar, the world's most liquid currency. By contrast, Chinese stock markets, though operating according to capitalistic principles, are controlled by China's ruling Communist Party. No government bureaucracy in China, whether it's stock market regulators, the central bank, or the court system, can be administered independently of party oversight. China's currency, the renminbi, which prices shares in mainland stock markets, is also managed by party and government authorities and essentially can only be used in China.
This also provides the central reason why the renminbi exerts surprisingly little influence globally in proportion to China's enormous economic size. We'll look at addressing that in more detail in another video.
In the case of Didi, its arrival in the New York Stock Exchange was especially well received. The $4+ billion capital raise the company was gunning for represented one of the biggest IPOs for 2021. Didi, in fact, was bringing to U.S. markets the biggest IPO of a Chinese company since Alibaba's record-breaking $25 billion debut in 2014.
And here's Jim Cramer, one of America's best-known stock investing gurus, throwing aside his usual misgivings about Chinese companies and getting downright gaga about Didi.
However, that doesn't mean you should give up on every single Chinese IPO. While a lot of them are indeed low quality, there's a big caveat. The larger ones, they tend to be much, much better than the smaller ones. Doesn't make them a sure thing, but it means they're sometimes worth buying on a case-by-case basis, which brings me to the one I want you in on. Didi, D-I-D-I. That's the Chinese version of Uber that's coming public on Wednesday. But as long as they stay on the Communist Party's good side, and I know it's probably hard to do, but as long as they do, I doubt they'll have much trouble with the regulators. So if you want to speculate on a Chinese IPO, you've got my blessing to bet on Didi. I would try to get as many shares as you can. D-I-D-I.
With consensus views on Didi so strong, it's hardly surprising that when its shares listed on June 30th on the NYSE, they came out with a bang. The stock began trading at close to 20% above its $14 a share offering price, and the long-term outlook was encouraging. Didi's IPO seemingly confirmed that the China to Wall Street financial pipeline remained strong and would keep flowing no matter how bad U.S.-China political relations became.
Yet it turned out this time was different.
The very day after Didi's American stock market launch, China's internet regulator suddenly announced that it was conducting a cybersecurity review of the company. Within another 2 days, China's Cyberspace Administration prohibited all new Didi app downloads. As a result, shares of Didi plummeted, wiping $15 billion in market cap off the company's opening day closing price. And that was just the beginning. In the immediate wake of Didi's market plunge, other categories of Chinese shares, notably in education, food delivery, and gaming, have been plummeting, with Chinese authorities pursuing a variety of reasons and ways for cracking down on a broad range of Chinese stocks in America. With Didi, the government relied on its all-time favorite justification, national security, 国家安全 as it's known in Chinese. Here alleging that Didi improperly collects and uses customer personal data. Since Didi is now a U.S.-listed company, government reasoning contends that by extension this exposes Chinese user data to prying foreign eyes. Apart from the anti-foreign paranoia reflected in that rationale, it shows how very little Chinese regulators understand about the way stock markets actually work. Even if Didi is mishandling user data, a U.S. stock market listing doesn't involve divulging such information. If it did, the likes of Apple, Amazon, Facebook, and Google would all voluntarily delist their shares because selling personal data is how they make money, not giving it away for free to shareholders or anyone else. Of course, the ways big tech uses personal information is a huge issue by itself, but that's entirely separate from what's tied up in being a publicly traded company. There are also huge ironies regarding claims of concern for consumer data protection in official Chinese actions against Didi. China's government itself operates the world's largest digital surveillance state. 56% of all the world's CCTV surveillance systems are in China. 9 of the world's 10 most surveilled cities are in China. Anyone who drives, rides, or walks down a street, enters a building, or makes a digitally recorded transaction in China is being monitored. For Chinese citizens, their information is not only observed, but scored, ranked, and kept in a social credit system, all with major implications for how people can live and work in Chinese society. Although it is the Chinese government, not U.S. stock markets, harboring an obsession for data on Chinese citizens, there is one critical piece of information that market investors expect and U.S. law demands of listed companies: verified financial records. Curiously enough, for the more than 2 decades that Chinese companies have been issuing their shares in America, Beijing has vehemently prohibited verification of financial audits of Chinese firms. That blocks a key component of compliance underpinning the integrity of U.S. capital markets. And this happens to be something that only Chinese firms have gotten away with on any scale. Fed up with the situation, in December 2020, the U.S. Congress passed the Holding Foreign Companies Accountable Act, giving Chinese firms selling their shares in America the ultimatum of a 3-year deadline to comply with audit verifications or be forced to delist. So whether it's from demands put up by Chinese authorities or American, Chinese companies won't be able to continue receiving capital through U.S. public equity markets without drastic changes in the political environment. The U.S. and Chinese governments have not shown themselves terribly capable with coordinating on matters of mutual interest, even in the best of times. Salvaging the China to Wall Street IPO pipeline is even less likely under the current and foreseeable state of affairs. So Didi has become an unexpectedly negative portent of what lies ahead. Within days of its once celebrated IPO, the stock plummeted to as low as below half its initial value. It only rebounded slightly when speculation arose that Didi would soon enough be delisted at a higher price. Although Chinese authorities are sure to view Didi's American stock market demise as a victory for asserting their will over a wayward private enterprise, and, let's be honest, a sense of satisfaction in sticking it to the Americans, in reality, the long-term implications are far worse for the Chinese economy as a whole than what a single stock's IPO debacle would normally imply. Without a fundamental restructuring of its financial system, China will never be able to create the sort of public equity markets approaching anything like those in the U.S. Without tapping into the type of capital that so far only U.S. markets can provide, the growth of Chinese firms such as Didi will be constrained. That in turn will ripple back to curtail the growth potential of China's economy. The ultimate irony here is that Chinese officials repeatedly complain that America wants to contain China's rise. Yet when it comes to denying access to the power of American stock markets to help fuel China's growth, Chinese officials are themselves proving quite adept at restraining China's economic future.
So how about an impact will that have on China's growth story? For one, Chinese stocks, whether listed in the US or in China, are under growing pressure from industry regulation and market intervention by Chinese authorities. The latest round of crackdowns against US-listed Chinese stocks that was set off by Didi fits a much bigger pattern. Private enterprises in China are navigating an increasingly charged political environment. You can expect more intervention from the state going forward. The previous $2+ trillion market value accrued by Chinese companies listed in America is suffering. Expect lots of volatility ahead. Yet in a global market sense, though likely to decrease, that market value won't completely vaporize either. When it comes to their inevitable delisting from US markets, many, if not most, of the firms booted out of Wall Street will look to relist their shares in the stock markets of Hong Kong and mainland China. That might sound like a good deal for China and probably explains much of the true reasons for the crackdown on US-listed shares, getting them to come back to the motherland. In addition to the idea that that will repatriate a vast amount of capital to China, such a development can be used to contribute to a narrative that China's Communist Party strives to champion, that China's economic system is second to none, and is especially not surpassed by that of its main geopolitical rival, the United States. Yet the problem is that the market-based reasons for Chinese companies coming to America to list their shares in the first place haven't gone away. Lack of access to the quality of capital offered by Wall Street will put a drag on the growth potential of many of the top Chinese companies that play a vital role in shaping China's economic future. Bottom line for investors, the party is coming to an end for investing in Chinese stocks in US markets. The way things are headed, at the very latest, by 2024, there won't be any Chinese shares available to trade in America. As laid out in this video, while that might satisfy China's current political agenda, it doesn't contribute to its long-term economic needs. In a still broader context, the coming exodus of Chinese stocks from the US markets is the latest example of China disengaging from the prevailing US-centric rules-based global economic system and trying to replace that with China's own version of global capitalism. Of course, the form of market-based capitalism that the US promotes certainly has its own problems, and many of China's critiques of the neoliberal world order are valid. Yet as Didi and the more than 200 other Chinese companies and their trillions of dollars in market capitalization have demonstrated, these companies have effectively voted with their feet to show that, whatever its flaws, the US system, in this case regarding public equity finance, can be vastly preferable to what's on offer in China. Another key point worth reflecting on. Although China has been expanding its economy at an undeniably impressive, in fact, frankly, stunning growth rate, that rate of growth isn't only owing to effective economic development strategies, the industriousness of Chinese workers, and the ingenuity of Chinese entrepreneurs. Those indeed were all key factors, but without access to global markets, China would have never grown as fast and as far as it has. As the country that has arguably benefited more than any other from the integrating process of globalization, turning away from the dynamics of global markets means that China's long-term positioning and influence in the global economy are going to be challenged to a greater degree than before. So you can expect headwinds to China's growth trajectory to be generated by the exodus of Chinese stocks from Wall Street. The net effect on the nation and its capacity to innovate and compete in the global economy remain open questions. Yet these are exactly the types of topics that geoeconomics will continue to monitor. I welcome you to check back here for ongoing analysis and commentary. I've written extensively on the subject of Chinese stocks in American stock markets. With Didi's US IPO saga, it seemed the kind of tragicomedy playing out would be appropriately summarized in a comic page. That's something you can download for free at geoeconomics.com.
For those who are interested in learning more about the background of Chinese stocks in America, through the same website you can also access more information plus a sample chapter of my book on this subject, Betting on China. Links are posted below.
Thanks for watching. Make sure to subscribe if you'd like to stay regularly informed on analysis like that presented today. Hope to have you back for the next installment.